So now I would like to call on stage Mr. Deepak Malik, Northern ARC Investments on stage. एक बार जरा जोरदार तालियों के साथ स्वागत करते हैं Mr. Deepak Malik.
Good evening, everyone. Hey, thank you all, and first of all, I want to thank PMStimes to kind of really give me the opportunity and Northern Arc for us to kind of really be in front of all of you here. Formally, this is my first trip to Chandigarh representing Northern Arc. So it's sort of really very heartening to see so many of you can really take time out to come and hear us. Quick one point I want to highlight before we get into what we essentially do here is we are Northern Arc. And invariably, this sort of happens that we get referred as Northern ARC. Let me sort of clear that notion right at the start that we are not an asset reconstruction company. We are, our name is Northern Arc and not an asset reconstruction. So sort of, I wanted to kind of really put that behind us before we move ahead on this. I'm essentially trying to build on from what Harbir was talking on the opportunity size and how that has sort of really evolved and what is the view on this space going forward. This is essentially a study done by EY Family Office. EY, and this is the Family Office report that they've done on where is it that, Ultra HNI Family Office investors perceive their allocations to kind of really be going forward, be allocated to different asset classes. And as you can see very clearly, one listed securities, no way that we are taking that away as an opportunity, and that sort of yet remains a significant part and allocation that an investor or family office does. And then while fixed income itself is very large, and again let me sort of really put this one disclaimer. In today's sort of event, I represent Northern Arc Investments, and we are the only debt fund sort of house here, and all the other sort of my co-panelists are essentially representing equity as an asset class, and we only talk about at Northern Arc only the fixed income opportunity. And within that itself, there is a certain sub-segment of that which we are essentially trying to cater to. So fixed income as well as equity remain a significant part and allocation of where investors perceive their future allocations to can really go. And the small aspect which is kind of really one segment that you see growing is other alternate investments, right? So when you talk about equity, again, equity or fixed income, it is sort of all-encompassing as a word, right? So equity includes both listed as well as unlisted. Similarly, fixed income, listed, unlisted, you have, a lot of segment within sort of fixed income, right? So you have real estate, you have distressed debt, you have special opportunities, you have, holdco company sort of financing. So it's very vast, right? But when you look at it outside these two segments, alternates is a segment which is essentially finding a lot of favor with Ultra HNI family office investors. And this is essentially, that recency effect is very visible in this report. The way startups have sort of really garnered a lot of investor attention, mind share, and allocation from family offices and Ultra HNIs, right? We as advisors have largely been sort of catering to a sub-segment of, the overall allocation that they do, which is, public markets via mutual funds, and which is, equities as well as fixed income, whatever is being offered via the mutual fund side. But alternates is a space where, you get to really participate in the rest of the ecosystem, which is, startup investing, which is new emerging spaces like, credit investing, as well as, private equity investment, right? When you talk about unlisted equity, it is not just the startup space. There's a lot of, So India's strength, essentially, we all keep talking about is the MSMEs, right? The MSMEs, and the biggest challenge there, and I think there's been reams written about it, on the access to capital. Access to capital is the biggest challenge for this MSME segment in the country, for them to kind of really grow and unleash the growth potential that India has. And that is where a segment of investor allocations have started to kind of really go via alternates. And that is essentially, it is going via a very structured format, via AIFs, via PMS. And that is where we believe, and that's what Harbir was also alluding to, that we as advisors have kind of really, or distributors have kind of really not really partake into that opportunity which investors are currently. What is the growth expected within these segments going forward? So there are a lot of numbers here. Essentially, it talks about equity is the largest allocation in the portfolio, which is at 35%. And the 7-year return is about 41%, that asset. So that asset class is by far the largest, segment which is catering to the alpha that an investor is looking at. The second, and that category is growing at about 13% CAGR. And then you have alternatives, which is again today, roughly about 20% of an investor, family office, ultra HNI's allocation is at 20% to alternates, which has delivered about 30%. And when I'm saying alternates, as I said, covers everything, be it private equity, venture, credit, everything gets covered within alternates. And that is the fastest growing segment today at 17% CAGR. Then there is hybrid real estate, debt, and gold, right? So when we are talking debt, this is more traditional debt, which is more your, the growth in your bank FDs, post office, corporate FDs. The traditional sort of segment is what is largely catered by debt. As I said, I'm here to talk about a sub-segment of the fixed income opportunity, and that is what is known as private credit. And also known as private debt segment. Within that, there are, how do you rate or how do you allocate capital on the fixed income side? We are essentially trying to look at it from return perspective. So they are by and large these 3 blocks or 3 buckets in which your returns are sort of classified. One is the essentially the AAA variety, which is AA variety, which is right now hovering around the 7 to 9% kind of annual yield, which is, again, you have multiple vehicles that you can use to kind of really participate here, right? One is mutual funds, you have PMS, you have alternate investment funds. Those are vehicles that you use to participate. So AA, AAA is largely catered to by mutual funds, and that's the segment I think we all are participating in. Then the other, which is the so-called performing credit segment, which is from a A-rated to right up to BBB minus. BBB minus is investment grade. And this is not, so general, and this is essentially coming as a feedback. Whenever I've interacted with a lot of ultra HNIs or advisors, distributors, the moment you talk about bucketing a paper or an entity in the sort of BBB plus, or rather I would say anything outside the A universe, the general perception is that this is junk, this is sort of completely, as a company could be out of whack and hence, not to be even touched with a barge pole. There are enough and more, sort of evolving businesses which are in this segment and which, when sort of approached in a very systematic, researched manner, is a very good opportunity. And that's essentially the opportunity that we at Northern Arc essentially cater to, the performing credit space. And then there is the higher risk variety, which is the unrated segment. And again, which is north of 16, 18, 20% kind of yields, which is where I said you will be talking about investing in to distressed debt, companies which are essentially going through NCLT cases. There are promoter M&A issue, sort of opportunities. You would have LAS opportunities, all of that. So when you have to kind of really plot all of them on the risk return chart, this is how the opportunity looks at the AAA, AA segment, which is the 7 to 9% kind of yield segment. Then the performing credit space, which is essentially the 10 to 15, 16% yield. And then there is the greater than 16, 18% kind of yield. So now this is the opportunity. And there are investors who are sort of participating in all the three segments. We as advisors or distributors have largely participated in the AAA segment. To a certain extent, we participated in the credit via what mutual funds were sort of really offering via credit risk mutual funds. And we've had whatever sort of episodes in the past, and I'm not getting into any of that. But the fact that, because of that opportunity not delivering the alpha that's supposed to do, advisors, distributors have kind of really shied away. And in the process, what we've seen, mutual funds as a vehicle have kind of vacated that space, right? And that is where you have specialized asset managers who can really coming in and sort of giving you a solution to participate in that space where it is able to meaningfully add alpha to you by mitigating risk, right? At the end of the day, as distributors, our underlying sort of thesis, and I think it applies not just to our sort of investors, but to our allocations as well. How do you, sort of maximize return and mitigate risk, right? That's all what we are all trying to do. And that's exactly what we at Northern Arc are trying to kind of really offer via these sort of performing credit funds. Again, private credit is, so you again classify your assets with physical assets, financial assets. We all know physical assets, real estate, gold, largely as opportunities. And then on the financial assets, you have equity, debt. Within that, equity listed, equity unlisted, and similarly on the debt side. What is a performing credit company, right? Where these are companies where unit economics is positive, their contribution margins are positive. These are companies which are not really cash burn businesses. It's just that they are small regional players, and hence the ability to lend to them at a higher yield is the segment that is the so-called performing credit space. And the very big difference, or rather I would say a highlight of the whole performing credit space is the whole DPI, right? Via funds that, one we deliver and how that whole sort of segment performs. There is this classification, right? So reporting that SEBI is required all AIFs to kind of really do on what is the DPI, RVPI. So DPI is nothing but distributions paid in capital. So if you've invested 100 rupees, how much of it has sort of come to you in the form of coupon or dividend, right? And the best part about this is the fact that a significant allocation that goes into this performing credit space is all coupon-bearing structures, right? These are quarterly coupon, semi-annual coupon. So you are not really seeing your NAV only move up and, there is an episode and there is a sort of NAV come down. You're essentially seeing, NAV go up and that cash getting realized in hand at the end of the quarter, right? So the very predictable returns and consistent cash flow. So that is a big differentiation for this segment. Unlike the other asset classes, and in particular, I would say equity, because, it's that animal is such that it will sort of tend to be very volatile. And you'll need to kind of really, take that in your stride, and then hence, over a long term, it sort of really averages out. And as Mihir was sort of alluding to, over a 15-year period, you've seen how equities kind of really performed, be it Indian equity or international equity. Here, you allocate capital, you get regular coupon, and hence you realize the gain that the sort of allocation is designed to kind of really deliver. Yeah, yeah, yeah. So what we do is at Northern Arc, we essentially structure our funds in a manner that they give you quarterly coupons or semi-annual coupons. We also have done in the past, essentially back-ended or redemption premium structures. But, so depending on what the requirement is, there are structures which are available and something like that. So we are talking about the opportunity. So this can be, as I said, catered to by any vehicle. So be it AIF, category 1, 2, 3. You can, or a PMS or an MF. And this slide is essentially trying to show how mutual funds have kind of really vacated the space. Because that vehicle is not suited for, credit investing. One fundamental point there is the open-ended nature of the funds, right? If you are running a credit risk mutual fund, which is open-ended in nature, and your redemption is paid on a T+1 or a T+2 basis, now that's the structure of how you are participating in that opportunity. And now you look at how the market is, how is the fixed income market in India structured, right? So outside your GSEC and your AAA, there is just no liquidity. So if I have to meet my redemption on a T+2 basis, and that I intend to do by selling paper in the market, we believe itself is flawed. So MFs in that sense, open-ended in particular, are not really suited for credit allocations, and hence they've also been wanting to kind of really get out of. And there are mutual funds who are wanting to launch AIFs to kind of really tap into this opportunity. So the vehicle sort of changes, and hence you also need specialized kind of, credit underwriting assessment for it too. So it is not that, you look at one lens, and traditionally how capital has been sort of provided or channelized to the economy in the traditional form is via banks and NBFCs. And historically it is, all collateralized, right? So against plant, land, machinery, project finance is how that opportunity has sort of, so the problem with traditional is it looks everything with that angle. The lens is very different, and today there is no one-size-fits-all approach. You need to kind of really tailor-make a solution to an opportunity or to a company, depending on the cash flow, depending on what the company, what is the kind of capital that they have, how are they kind of really addressing, what is the gap that they are facing. And how do you, so there could be a working capital gap, there could be a long-term sort of requirement. See, the market is so vast. I mean, you have, I don't want to get into specifics, but you have, you have HDFC Limited, issue CPs, right? This is a mortgage business which is lending money for 20 years, and why does he need short-term money? I mean, in the sense that he's borrowing short-term. So there are, that there's no one-size-fits-all approach. There has to be a tailor-made solution, which is where you would need that specialized underwriting capability to be able to then sort of participate. And that's where we believe a large part of that allocation going from mutual funds can really been vacated. And the last sort of nail in the straw, so to say, in the coffin rather, was this whole sort of regulation on that, the tax advantage that MFs had. So that was something that we at One Northern Arc and the entire space were struggling with the fact that if I am delivering a fund which is giving you about 12.5%, 13% kind of post-expense yield, but for an investor he says 3 साल के लिए पैसा डाल रहा हूँ और उसके ऊपर you pay full tax at 40%, you are left with about 8% or thereabouts. And then when I'm investing into a fund which is, say for example, again in the 8.5% sort of a post-expense yield, There with indexation I'm yet. So for that 50, 100 basis points of extra alpha, the risk wasn't justified. So I think that also has now sort of gone away, and hence everyone's on an equal footing. So that is where your credit underwriting and your assessment of the whole, the segment is what becomes the differentiator. So there are, so as I said, we have category 1, category 2, category 3 funds. Category 2 funds are, ranging any from 3 years to 10 years. So one, on AIFs, it's on accrual strategy. It's an accrual strategy, and yeah, so practically a significant part of your portfolio is tenor matched. But yeah, the risk there is obviously the credit event playing out. So by no means am I saying here on this platform that it doesn't come with risk. It comes with its own set of risk. But how do you risk mitigate is what we are essentially trying to kind of really do here at Northern Arc. As I sort of really showed here, right, in the 10 to 16% kind of gross yields is where we work on. So depending on what is the tenor, what is the structure, yeah. So what is the risk level at which you want to get in, right, is where these sort of opportunities play out. Very, very pertinent question. Good that you raised it up. See, it's a good company, but the scale is very small, right? So typically, bank doesn't come in very early stage. And the bank funding is so onerous as well, right? You need to give them cash collaterals, you need all banking relationships. And a lot of, promoters of late have also become very wary with banks, especially, these kind of relationships with one primary bank. All your business sort of is sort of being routed through the bank. And at the first instance of a red flag, and we've seen instances where the bank will sort of really, take whatever is there in the account and freeze it to that level. And hence, while you could have still overcome that sort of red flag, now for sure you're gonna, have to wind up. So those are where, so banks do participate, but banks are not the only provider of capital to them. They need a lot of diversification on their liability book as well. So how do you participate in this space? You participate, and we've essentially classified this into 3 segments. One is do your own research, go buy. So essentially like buying a direct stock, right? So everything depends on your assessment, your monitoring, your ability to kind of really decipher the numbers that are there. Then the second would be a syndicated offering, and which is largely done, by so-called investment bankers who are essentially assessing an opportunity and showcasing the paper to you. And mind you, that at the end of the day is yet an iBanking transaction, right? He's coming, he's done an assessment and he's showcasing that opportunity to you. Once the transaction is done, he moves on to the next, and then you have to make sure that you are sort of really following up on the company and how that company, because there could be red flags over the, say, a 2, 3, 4 year tenor, whatever you've taken, and how do you action those, and how do you kind of really safeguard yourself at that time. And then the third opportunity is via an asset manager, it's not an iBanking transaction. He's one who's researching, he's the one who's allocating capital, he's the one who's monitoring, he's the one who's sort of really making sure, the corrective action is taken well in time so that you don't have accidents along the way. So these are by and large the 3 ways by which you can sort of participate in this whole opportunity. Quick lowdown on Northern Arc. We're essentially a debt platform, and we work in the performing credit space. This is a segment where, as I said earlier, anywhere between 10 to 15, 16% kind of yields is what we demonstrate by having significant skin in the game. We have large teams who can really monitor. So it is, when I'm allocating or when I'm sort of really deciding on a portfolio, my assessment doesn't really start from what is the rating of the entity, right? So it doesn't start saying that while I told you that this is how you bucket the opportunity, but when within that I am looking at a security or an entity, That sort of is not as a function of because it's a triple B or it's a, an A minus or a double A minus kind of a paper. Hence, I'm evaluating. I'm essentially evaluating it more from an entity perspective rather than the rating. So rating is more ancillary to us because that's something that you as an investor will be able to relate to. And for me, this ground level monitoring, which I spoke about earlier, where I'm actually visiting their branches on a quarterly basis to understand what's happening at the ground, what will give me early signs of stress. And that is what we essentially is our differentiation versus just sort of really picking it up from a more macro kind of a viewpoint. Then the other is we can create bespoke portfolios. These are cash flow structures. All these things that I've essentially spoken about earlier. We as a fund house, we are okay. So this is a group which was started by a bunch of ex-bankers. Northern Arc was essentially started by, these, I don't know, there was this one gentleman, Dr. Nachiket Moore, ex-ICICI Bank. He, along with few friends and colleagues, essentially came together to essentially work towards financial inclusion because there are segments of the market who didn't have access to capital, and the idea was how do you make that access available. And so the idea was Northern Arc was formed where he'll raise money from the market, provide that capital to these NBFCs in select sectors, and help them risk underwrite, help them scale up. So that's essentially what we started off doing, and we continue to really only focus on those financial inclusion segments. Today we manage about 3,500 crores of current AUM, plus there have been about 5 funds which are matured and paid back. So a little more than about 5,000 crores is what we've essentially managed and paid back. Till date, we've not had any accident. That essentially talks about the underwriting that we essentially bring to the table. The smallest manner in which I could tell you how do we do our risk monitoring, how do we do our assessment, right? So it is, entity goes through a lot of filters before we even decide to lend from our own balance sheet. And once we do, the entity shares data with us on the end of every quarter, and which is then verified by our risk monitoring team, which is out on the field 3 weeks out of 4 in a month, and meeting these branches to understand what's happening at the ground and relay that back to corporate office saying that these are the sort of any stress or no. And basis how the balance sheet is shaping up, how the repayments are happening with the entity, we also go syndicate for them. If there is any red flag identified, we've sat across with managements, we've sort of really said these are the flags that we have, we would want you to take these 5 steps to really correct it. More often than not, it's done. There have been instances where, instead of 5 steps needed, they've possibly taken 3. We've exercised put options or accelerated our exit, and thereby we have a track record, which is what it is. Kind of an audit role, but the fact that you do this religiously quarter on quarter without fail, and what sort of really sets us apart is how I would like to really sum this up.
Thank you so much, Mr. Deepak Malik.